The information in this podcast is educational and general in nature and does not take into consideration the listener's personal circumstances. Therefore, it is not intended to be a substitute for specific, individualized financial, legal, or tax advice. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a final decision.
Hey everyone, welcome back to another episode of In the Market Trenches. You'll notice that this is the first episode that Gary and I are actually recording together. We're at the beach house, and Gary, he was even trying to social distance here. He's over at the couch, and we're going to do this on two screens. I invited him over. So
Eric said, "Hey, dummy, come over here. We're doing the real world of investments here." And
I'm happy to have you here. We're happy to have our guest here with us today. And
it's the first time a non-family member has touched me in about 6 months.
I don't know how I feel about that.
All right.
So thank you for joining us today. If you're new, remember you can check us out on our blog, www.accretowealthpartners.com. You could subscribe to us, download the podcast wherever podcasts are available. You could also find us at inthemarkettrenches.podbean.com. You could find us at snn.network or on the SNN YouTube channel. It's youtube.com/SNNwire. Today, we have a special guest for you. Really excited to have him here. Steven Kiel of Arquitos. He's the portfolio manager, the founder. He has a lot of great stories. I've talked to him offline multiple times about his investing. Steve, welcome. Happy to have you here.
Hey, thanks, guys. I wish I was at the beach house as well. I don't know that we could fit the three of us on one screen though, so I might have to go out on the deck. You guys can sit there close together, and I'll stay over here.
Yeah, you're in New York City, right? Today?
I'm in New York City.
Oh my. All right.
Right.
Before we get too far into it, can you just tell us a little bit about yourself? Tell us about Arquitos. Tell us about your initiative with. I think you've got a fund of funds thing going, and anything else we should know about you before we dive into the trenches.
Yeah, I started Arquitos in 2012. I was a recovering lawyer, and still am in the Army Reserves, almost finishing up 20 years there. So still kind of practice law in the Army, but thankfully was able to transition out of that career and start the fund, get into investing. The day-to-day life is much more fun and exciting as a portfolio manager and an investor than it was as a lawyer. If anyone listening is contemplating going to law school. And yeah, we took over a small public company in 2015, started a asset management subsidiary from that. We seeded a fund, Alluvial Capital, Dave Waters, a few years ago, back in 2017, and we launched a couple funds as well. So Willow Oak Asset Management now has a seed investment and also handles operations for several funds, including my own. And we're looking to expand that actually over time here to bring on additional funds to that platform. And I think there's a great opportunity, especially for sub $100 million funds that need additional infrastructure. Willow Oak can provide that in a way that allows the portfolio manager to focus on investing and not get hung up on all the logistical operational distractions, investor relations, things like that, which are very important, but it's difficult to do when you're also spending the entire day doing research and managing the portfolio, which is what you should be doing. So yeah, excited to be here. Happy to talk about some of the stories through the years.
Yeah, you guys are bearing the sort of the back office and marketing sort of brunt with that, right? Dave Waters is funny. He's a fellow Grove City College alum. Me and him are the only two, I think, of us that are in the world of investing. So we went to the same undergrad, believe it or not. Small world.
It's a good, apparently, I think Dave actually, I think he was more like social sciences and things like that. So, it's nice to not get, you have an MBA, right, Gary?
Yeah, I went to UVA for an MBA after.
If there's any confusion.
Darden.
Yeah, if there's any confusion, I've got the swag.
Well, at least you didn't have to unlearn anything from undergrad. I'll say that. I think that was the situation with David as well. Sometimes you have to and it's kind of like that with law school too, that you learn all this theory and then you get out there and practice law, and it turns out none of that is actually how things are done.
Yeah.
No comment on that.
We've had a fair amount of experience with lawyers the last couple of years, and we have no comment. Okay, so let's see. So Arquitos, if I remember correctly, I know you said 2012. I remember reading some of your letters. You did deep dives on a number of different sort of NOL shells, net operating loss vehicles. You were very, as I recall, very big into that, at least in the beginning. I don't know if that's still the case today.
Yeah, definitely in the beginning. It's a little bit different now since the tax law changed. The opportunity kind of went away or potentially reversed. Once you had the corporate tax law reduction, some of those smaller NOL companies, that value of that wasn't as important, first of all. And then second of all, the opportunities came about in the last couple of years for some of the conversions. So limited partnership conversions to corporations. And we saw tremendous stock market returns from that when you think about the larger companies, whether it's a Blackstone or something like that, then there's index inclusion opportunities as well. But the promise of the NOLs, I think in the early day was exciting. The realization of them, there were some stock price increases for sure on the potential from some of those companies, but the realization of those many years later has been, I don't know, can we curse on this? I mean, shit. They've not been good. There was a lot of potential and opportunity, and activist investors got involved. There was special situation things that happened that were exciting, that it seemed to have a lot of promise. And then when these companies made acquisitions, the acquisitions that they made just were not a right fit for that style and for that to utilize those NOLs. And I can't think of, maybe there's one or two companies that have worked out really well from those NOL shells, but for the vast majority of them, they've not been good.
Well, it's in my experience, it's not usually been the NOL. If it's worked out, the NOL has not been the key driver of the success. Eric and I are recovering NOL addicts ourselves, and we've been lured into an NOL shell or two over time, and we have the scars to prove it. And what's funny about these things, and I've noticed that, I've seen some with a pile of cash in an NOL, and then they go out and do a deal, and I'm like, why would you do that kind of deal? Think about and from my perspective, if Buffett had a NOL shell with a wad of cash, what would he do? And I don't think he'd go out and just buy a crappy business with a lot of leverage. I think he might just go try to find See's Candy and stick it in there, or whatever version of that he could afford with the money he had, and just let that work itself out over time. A lot of these wind up being kind of too cute by half. And now our estimation on it has been that the NOL shell is only as good as the plan to use it. And
totally.
That's where we've come down on this over time.
Totally. I completely agree. And some of these really did run up in prices though. So depending on what your entry point and exit point was, you could have made a tremendous return, but it's very difficult to time things, obviously just overall, but especially in those types of situations, because even when the stock prices had run up, there was additional kind of promise associated with it, so to speak. I think the best NOL shells are what are kind of post NOL shells at this point. There's a very under the radar company called Pendrell. We'll talk about a different company, of course, but Pendrell's an interesting one because they delisted, they did a reverse stock split. The stock ask right now, I think, is $150,000 a share. So they just tried to go under the radar, and they're playing a long game with it. They just sponsored a SPAC, and they're basically attempting to do different investment opportunities through that without levering themselves up. And I think that's the way you do it. That's a financial engineering type of thing. But that's one way to do it that is probably better than what most of these small cap NOL shells did over the last. This was from 2010 to maybe 2017. I don't know that there's a whole lot of things going on right now with some of them though.
No, the thing that we've looked at with NOLs recently has been with the CARES Act. There's some carryback provision that you can take losses back to 2013, and there's some interesting stuff on that. It's sort of but you're looking for a very, very specific type of business pattern, and it's sort of a bit rarer than you'd like to see. But why don't we go into the specific one that you've got some battle scars to discuss here. So which NOL shell are we talking about? And I want you to take me through how you found it and sort of the journey it went through.
Yeah. So the first NOL shell that I found when I started the fund back in 2012 with this company called ALJ Regional Holdings, and I actually discovered it through Dave Waters at Alluvial. He had written it up on his blog, otcadventures.com. And I got into it. The interesting thing for me is at the time, I was not really into these NOL shells. I was more interested in these large tender offers. So, I set up these different SEC filing alerts, and you see a tender offer filed. I'm looking for, just like you guys, I love these special situations. I love things that, things can become unnaturally cheap because of misunderstandings, generally through company-specific special situation things. And that was the case with this company, ALJ Regional Holdings. There were a number of special situation items to it, which I think would be interesting for us to talk through several of them, not just for the company themselves, but as a kind of microcosm or as an example that we can use to maybe find other companies in the future. But I initially discovered it because of this large tender offer. And they did the tender offer because they had divested one of their only holding, their operational holding, which was a steel company in Kentucky. So they sold it, they paid off all the debt they had from it, and then they did a tender offer and bought back 50% of the shares. And I think it was a $50 million company at the time, so they bought back, market cap, so they bought back $25 million worth in this tender offer. And what was amazing about it was that they kind of projected over the next year, no cash burn, very limited overhead. And the executive chairman owned, after the tender, he ended up owning 50% of the company roughly.
Got it.
So it was fascinating though, because they did this tender offer and it was below the net cash value. It was 20% below the net cash value at that particular time of the company, with really no cash burn or very limited cash burn.
They were just running it for what, public company costs or something like that?
Yeah, just public company costs, but they were not listed at the time. So, it was pretty low. And even the audit was very simple because at that point they had already made the divestiture. The audit going forward was just this shell. And it was amazing then to see $25 million worth of people, shareholders, tender their shares below its liquidation value. And that's when I got interested in it.
Okay. At that point in time, did you know that it had tax attributes, or was that just something that was?
Yeah, it was already known because they applied, I think they applied some of them to the sale. They made money on the divestiture of the steel company. And so they applied, I think, some of it to the profits made from that, and they had leftover. And the tax assets they were going back like many years. We're talking about, this was 2012. I think the tax assets were generated in 2005 or 6, that time period. And so, it was kind of interesting in that way because they then had these tax assets, right? You had no cash burn really, very, very limited. The executive chairman was not taking a salary or anything like that. So you had high insider ownership. So you had that alignment. And then, again, it traded at less than liquidation value and had the tender offer. And so, have you ever seen a tender that was accretive to liquidation value by 15 cents a share or something like that when it was trading at 70 cents a share?
I've seen a lot of serial buybacks in the market that had that kind of characteristic to it, but not a full-on tender.
No.
Not 50% of it. Yeah, it's. I mean, there's some right now actually, some significant buybacks for some of these smaller companies because as the market has gone back up, it's primarily been the index-related companies, the larger companies. And a lot of those small cap, more balance sheet strength types of companies, small cap value, whatever you want to call it right now, they went down, but they haven't come back up really yet. And the smart ones, that's how you determine whether there's good capital allocators at the helm or not.
Right.
Smart ones are doing buybacks, and those are.
At this point, after they did the divestiture, did they reveal what the go-forward plan was?
They said that there were plans to make acquisitions to utilize the NOLs. The executive chairman was an experienced investment banker. He was involved. He ran a bond fund at TCW. He was
right.
He worked with Michael Milken in the 80s. So he was an experienced investment banker. He knew what he was doing, and it was obvious that he knew the value of the NOLs because he didn't tender any of his shares. Of course, he used it as an opportunity to increase his percentage of ownership. So there was not a specific plan that an acquisition would be made, but it was obvious from kind of some of the comments, the language in the filings, and if you had any conversations with them, it was obvious they were looking for an acquisition to utilize that asset, and he understood the value of that tax asset very well.
Got it. Got it. So from that point, how did it unfold? Like, what did they do? What did they do next? I seem to remember this one, and I don't know if they did one or many acquisitions. We were not involved in this one in particular, but I do remember at a time, and I saw a couple other NOL plans put forth that other funds put together on the basis of using ALJJ almost as a template.
Yeah.
And those did not pan out, or well, I guess some of them remains to be seen, but I've not seen anything based on, that I've seen some templates based on ALJJ.
Yeah. And it's all about that acquisition, right? And so ALJ made 3 acquisitions. The first acquisition, I think it was a solid one. It was a company called Fanuel. It was a call center company. They made that acquisition 9 months later after the tender offer, and they borrowed money to do it. And I think the plan, or at least the plan that appeared to me, was that you would buy this company, you'd lever it up, it throws off a lot of EBITDA, but there's not taxable income, so the NOLs are not really getting used up. But I think the longer term plan was that you reinvest in this business and have the opportunity for growth, and then 5 or 7 or 10 years down the line, you sell it for significantly more than what you bought it for, and that's how you use up the NOLs, as long as you do it before.
So a large capital gain on the back end was essentially the plan.
Because that's what they did with the steel company too. And I think that was the playbook going forward. And Fanuel, the first acquisition, was probably a good one for that. Relatively predictable business. They processed, it's kind of a call center. They also process like speeding tickets. They run tolls, like a SunPass down in Florida. They run that program. So they're like an outsourced kind of recipient of those just business processing type things. They do billing for like Dominion Power in Virginia, those types of things. And then they started getting into during the Healthcare Act, whatever number of years ago, to process like signups and stuff like that. So not a bad business, right? But again, the issue was not throwing off kind of taxable income.
Right.
And so, fine. The second business then they bought, which I think was sort of an opportunistic play. They bought it was a flooring company in Las Vegas. And it was just a few $1 million. It was very small, whereas Fanuel was, let's say Fanuel was like 30 million or something like that. I have to specifically check the notes. It was larger. And so the flooring company in Vegas never made a profit, has never, it may be for a couple quarters or two, but it's been, I think again, they had the opportunity, they thought they had the opportunity to grow it, and that never happened. And just not a good fit for that type of
It's growing the NOL, it's using it.
Yeah.
It's growing the NOL. It's not using the NOL.
It is growing the NOL. So, I guess depending on what your NOL strategy is, it could have been good or not. But then a couple of years later, they bought a company called Phoenix Color. So these are the 3 holdings right now, the 3 subsidiaries. Phoenix Color was a printer primarily related to educational materials and things like that. Same situation. They really levered up for this one. And it also has not been doing well. And certainly, it's been, I don't want to say something, it's fine, right? But it's not creating taxable income due to the debt. And it's a melting ice cube.
Yeah.
It's those types of situations where I think Fanuel actually had the opportunity and has grown. And if they could really, we'll see what happens. They had a few missteps here, but there is still that potential with Fanuel, that first acquisition, to carry through on probably what the original strategy was. The other 2 acquisitions, in my opinion, have not been good, not worked out well. Now, again, though, you go back and you say, well, if you're an investor, it depends on your entry and exit point. So today, the stock has reacted to all of that debt and all of the issues with the subsidiaries that they have. Now, it's been a number of years, right? So they first made the Fanuel acquisition, it was 2014, or late 2013, that time period. And then they made the Floors and More, it's called, Carpets and More, I think early 2014. And then Phoenix Color was a couple of years after that. Well, now it's been 4 years, right? 5 years since these acquisitions have happened. And the stock price is all the way back down to what it was when it was a shell company.
Yeah, I mean, I don't have a chart, but if I did, it would be like it went like this,
Yeah.
and then like this,
Yeah.
and if you're looking at it, it's sort of like the chart's giving you the finger.
Well, I think it did. It did give a lot of people the finger.
When do the NOLs start to expire?
Yeah, so the NOL, excuse me. I think they begin, I think the first ones expire 2022, and then it's over the next 3 or 4 years that the majority expire. I'd have to check back my notes here.
I mean, so is it reasonable
because the
I mean,
thesis has gone away here, but ideally over the next year or two, they're going to divest. If they can part of the strategy, they'll divest one of those businesses at a profit. We'll see. Hopefully.
Yeah, hopefully.
Fingers crossed. So this is one you're no longer involved with, right?
I still have a small position. I had a big position in the beginning and through the time period where it had all these kind of special situation characteristics that were interesting to me. Now it's not really a special situation play anymore. And I had at one point I had sold out completely and then had bought back in a smaller position. So now it's a smaller position in the fund, and I'm just kind of riding along with it because in my opinion today, it still is very cheap. There are fears about the debt, but if those, they're close to the covenants being tripped and things like that, but every time they've been renegotiated, and there is still value, I think, with some of these subsidiaries. And so difficult during this time period for the sale process if they do or end up looking to do that over the next few years. So we'll see what happens. But, in my opinion, at this price, there is certainly some risk with the debt, but I mean, it is pretty cheap. And, going back, originally, again, that liquidation value at the time of the tender offer was like 75 cents, something like that, 76 cents. And, they did the tender offer for less than that. And we can talk through some of the other special situation characteristics, but it ran up above $5.
Yeah.
In say 2017 time period, and
right.
So you said
depending on your luck at trading,
right.
you may have done well, or you may not have done well at all. Depending.
So take us through your thinking as it evolved over time. They're doing these deals. People seem to really like the stock. The guy that's in charge of it has, at one point, I don't know if he still has this or not, but had something of a cult following among sort of small microcap investors. I don't know if he's maintained that status or not, but like sort of just, because obviously it's come back way back in. So take us through your thinking as it evolved. Like what sort of happened as it went along? Like were there sort of projections that weren't hit? Was it sort of, Eric and I, when we experience these things, a lot of times it's almost like we call it the boiling frog.
Yeah.
If you throw a frog into hot water, he's going to jump right out. But if you heat it to a boil, that's how you kill him. It's like, we've experienced that a lot. And I should tell, we've experienced that more times than we would like to experience.
Enough to start a podcast about.
Enough to have a podcast.
You're not alone. Look, I mean, if you invest in any time period, you're going to have those types of things. You just have to be worried about thesis creep. If you got in because of some of these special situation characteristics, when those things are complete or are done, or if something changes, your analysis of the business or something like that changes, you do have to get out. And that is one thing where you have to appreciate Buffett. When he goes to exit a position, he doesn't just trim it, he blows it out. He'll just get out. And that happened with the airlines earlier this year. It seems like it just happened with Wells Fargo as well, very long-term holding of his. And if you start to just kind of trim it, you don't, if you make a decision that you're not interested in the company anymore, the operations, because of something has changed or your analysis was wrong, it's better to just blow out, I think. But going back to the early days of ALJ, again, it had this tender offer, had the NOLs, the acquisition seemed interesting. And it immediately, I think it ran up to about $1.80 from 70 cents a share after the acquisition. So that was interesting and it seemed like there was more value there too. But then, once you go along and you see, well, I wasn't looking to invest in a company that has so much debt. You want a strong balance sheet company, all of a sudden it doesn't have a strong balance sheet anymore.
Right.
But the next thing on the horizon was they uplisted to the NASDAQ, right? So they were a non-SEC reporting, I believe they're non-SEC reporting, pink sheet company.
Yeah.
And they were. And then they uploaded, they became SEC filing company. They did an S1, they went up to the NASDAQ. And then you know what? Next year they get into the Russell 2000, right? Yep. So that's another opportunity. And that's actually when the stock price really flew. Yeah. You know, once you get into the Russell 2000, you get that index inclusion. The float was very low because the CEO or the executive chairman owned half of the company. And so I think this is the lesson for future things, you know, future discoveries of companies, that when these small companies with a low amount of float get index inclusions, then there's opportunities for really rapid movement in the stock. And that's what happened. That's really when it ran out. But at that point, operationally, once that index inclusion happened, that's where the special situation things ended.
Right.
You had 5 or 6 of these things that were interesting to people like us. And then after that, it was just a levered.
It was just a levered call center flooring.
Some NOLs that weren't being used. Yeah. And with businesses that were kind of melting ice cubes themselves.
Yeah. I mean, one of the things that Eric and I have noticed over time is you sort of have to take the liquidity when it's there. If it's there, it's because it's, it comes and goes.
It does. And that's one of the interesting things, especially with small caps, where you'll see, you know, when you run a fund, when you run a portfolio, and once you get to a certain size, you do have to take into account the liquidity ability to buy into the company, and also if you do need to exit, depending on what your kind of terms are with your investors. And so you do need to take that into account. But it is a little bit dangerous, because if you look at like average trading volume or whatever the last 90 days or even something like that, it can seem either overly high or overly low, depending on what sort of activity is going on or excitement at that particular time. And quite frankly, when you have distressed time periods, most companies' liquidities go away, you know. Right. So it doesn't matter if it's a tiny $50 million company or if it's $1 billion. I mean, yeah, of course, a large company, but it's still going to have a very, very large company will have it. But they're $1 billion companies that, you know, things can move because even big block sales are being traded by larger funds that are liquidating, and it's not something that is as predictable as people think in terms.
Well, it's sort of amazing how reflexive liquidity can be. So when it comes in waves, and when it goes, it's gone. And you know, it's amazing the extent to which I think price is set by the incremental buyer and seller in some of these names. It's just, you know, Eric and I own things that, you know, somebody comes along and wants to bank some out that day. It's you know, you're going to deal with some tough prints.
But that's the opportunity too, buying in, because that's a provider, right?
Yeah.
So interesting. What did we go through some of the lessons learned, or did we get to that point yet? Or
yeah, we can. I mean, I think for me at least, and I'd love to actually hear your guys' take on this as well, hearing the story, you know, because now that it's kind of come full circle. I mean, I did well on it, you know. It's not an issue of, I still own some, but you know, it worked out well if your timing was lucky, or if you made the decision when that thesis kind of changed, right? But the lesson for me was, look, it is attractive to get into companies that are doing significant tender offers. It's amazing that occasionally this happens at below liquidation value. And when there is insider ownership and that alignment, you can do very well in those companies. You don't have to make it a 10-year holding, but you can trade on that. You can get in for a year or two. You can see what happens, but there is alignment there. And I think it's valuable to look at companies that have that alignment.
Yeah.
And so you have that. You have, you know, it's a way to judge at the time what would be good capital allocation. Now, that's a positive thing to learn, and also the index inclusion things that we talked about as well. Now, the more negative lessons I think to apply, or that we've learned from it, or I've learned from it, is that once it levers up, you got to be careful. You know, if you're originally interested in a company because of its strong balance sheet, and there's that strong balance sheet also gives optionality for future acquisitions. Once the acquisition's made, the marketplace generally overreacts positively to the future. And it is a better situation, like you said, better to sell, to sell the news and not have to follow all the way through on the operations themselves. Because there's one thing we were talking before this started, you know, Expel has gone through the roof, and you know, there's the operators there are fanatical. But when you're doing a financial engineering type of thing, which is what this is, the operations are going to be it's not, the leaders don't have that experience, and they're not fanatical operators. They're fanatical financial engineers.
Yeah. I think in our experience, when we've looked at these, they've been more financial people. They've been more kind of distressed guys, more valuation focused guys.
Mm-hmm.
And, I guess they would recognize a good business if they saw one, but they can't sort of bring themselves to pay up for one. They'd rather do something that's kind of cute and get something that looks like it's got a low multiple, even if it's sort of kind of a crappy business. I mean, it's I've always wondered with these things why somebody doesn't come along and put something in there that actually generates good profits at good margins and just protect and just shelter the income and reinvest and has good reinvestment runway. Like, to me, that would be like the optimal kind of thing to put inside one of these things. But if you think about the type of person that gets control over one of these types of things, it's not somebody who thinks that way. Typically, it's somebody who, is out there buying some distressed debt or something like that, and then they get a stake or like whatever it is.
They have the skill set to turn it around because they don't have that operational fanaticism to turn something like that around. Doesn't say it couldn't happen, but it's much less likely to happen from a financial engineering type of operator from the company. So no, I completely agree, and I think for something like this, the special situation characteristics and categories are worth looking at and seeing if they apply in other companies.
Right.
Mm-hmm. That I like that aspect of it. But again, the negative thing is once it's different than the things that you're interested in. This happened with Real Industries a number of years ago as well. I don't know if you remember that company where Sam Zell was involved.
We have some experience with that one. That's maybe one we can talk about at some point.
I had some negative experience with that as well. And and again, though, they made the acquisition and they levered up, and that's when the stock ran up. That's the time to get out.
Yeah. That one, I think they levered up to buy a business that they didn't really control their key input costs and their margins. And it's sort of like you're driving a car at 75 miles an hour with a dagger on the wheel and no ability to turn. Eventually, you're just going to crash and die. At least that was the way I viewed it when I saw what they were doing, and I was like, all right, well, we were very interested in the rights offering actually, and we participated in the rights offering, and actually, that actually turned out okay because we came to the conclusion about the car and the dagger very early on. We didn't stick around to see the rest of the story.
As long as you sell out, for sure, and that's the thing. And that's another. I'm glad you brought up the rights offerings because that's another great opportunity, a special situation opportunity at times, because the rights offerings will show up in S1 filings, and the S1s are typically filed as drafts. Right. Yeah. So for smaller companies, because they don't get the confidential treatment that a larger company might get. And so if you have this set up in your RSS feed, you can see there's 5 or 6 S1 filings every day, and they're massive documents, but maybe 1 out of 30 of them are interesting, but you can scroll through real quick and see whether it's worthwhile to look deeper at it. And if it's a rights offering of a company that seems to have some sort of plan, again, you don't need to hold on for 5 years to see the plan carried out. But there is the reflexivity about the excitement that there is a plan, and now all of a sudden they've been able to raise all this cash, and there's run-ups associated with that. And you're getting it in at a discount with the offer.
We like to look at them, particularly when it looks like management or some financial backer is trying to engineer sort of an off-market deal to put a lot of money into the company at like a contrived price. And you don't even necessarily need to buy. Like what we found is we don't even necessarily need to buy to get the rights when that happens, because the holders are going to. So most of the companies, and particularly in the smaller companies, when you need to do a rights offering, you've actually got to put up the cash in your account to do it. Like they don't let you do it on a margin account or anything like that. So like what happens is a lot of folks will get the rights and then they'll finance the participation in the offering by selling the stock itself.
Yeah.
And it'll arb itself actually down to the offering price. So it's almost like physics in a way. Like it just kind of happens. And so that's one of those things that we've frequently spent a little bit of time some time looking at. So
yeah, for sure. Those are interesting.
So, well, this has been a lot of fun. We should probably have more conversations like this because it sounds like we fish in similar ponds. And we know some of the same people, and you're
Well, hopefully we can find a current opportunity to discuss maybe buy into it instead of some of these historical ones that some worked out, some didn't. But, we're keeping our eyes out there for sure. I know you guys are too. And I think, look, when you have a distressed kind of economic situation right now, I think next year there's going to be some divestitures that'll be interesting. There'll probably be some rights offerings or some acquisitions from companies who are effective capital allocators that can take over some distressed things, but might actually be good operators in that case. So there's a lot of stuff to watch and look at, I think, over the next 6 months or a year. And I mean, if we ever we'll see what happens when all the economy opens back up again, and if there's inflation and what the Fed does and the political aspect and everything like that. But those types of uncertainties and dislocations economically is what creates opportunities, I think, for investors like us.
Yeah, I agree. Eric and I we always find something to do.
Yeah.
So
I'm sure we're sharing ideas for the future.
Every year there's like 3 or 4, 5, 6 things to do something over the course of a year. Every other month we find something that we're really fascinated by. So
yeah. And I think the biggest takeaway, if I can close on my end, is those tender offers. I've had a number of those that have worked out very well when there is a strategic reason behind it, and when the majority or controlling shareholder is not selling.
Right.
So there was one a couple of years ago, Intra-West Resorts, that was great. It was partially owned by a private equity fund, and they were doing a tender offer and not participating, even though the end of the life of the fund was coming up, and they still didn't sell their shares. So they had something going on behind the scenes.
Mm-hmm.
Right.
And this is what happens in the companies. You have to be humble to the fact that there are discussions and strategies that are going on in the boardroom that we don't know publicly about, no matter how much research and scuttlebutt you can kind of do. But you can see the incentives there, and you can follow those incentives, and it's worthwhile. Even with some uncertainty, it's worthwhile opening up a little bit of a position to see where it goes, because sometimes those are multi-bagger opportunities.
Yeah.
Well, Steven, we really appreciate you being here with us today. Where can people go to find out more about your fund, more about you?
Sure. So you can go to Arquitos.com, ARQUITOS. I'm on Twitter at Steven with a V _Kiel, Kiel. And then also obviously involved with Willow Oak Asset Management as well. And that's willowoakfunds.com. And happy to, share some discussions on Twitter and elsewhere.
Awesome.
Wonderful.
Thank you so much. Thank you everyone for tuning in today. You can check us out on our blog, www.accretivewealthpartners.com. You can find us, download podcasts wherever podcasts are available. It's also inthemarkettrenches.podbean.com, or you can find us at snn.network or on YouTube, youtube.com/SNNwire. Steven, thank you so much. Really appreciate you being here with us today. Anything else?
No, I mean, if you're out there listening and you've got a story and you'd like to join us, we'd love to hear from you. And if you could rate and review us, it helps us out.
All right. Well,
Thanks, guys.
Gary and I are going to the beach.
I'm
Take care, guys.
Take it easy.
Thanks, Steven.
The information in this podcast is educational in general in nature and does not take into consideration the listener's personal circumstances. Therefore, it is not intended to be a substitute for specific, individualized financial, legal, or tax advice. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a final decision.